Paper gold is credit, which you can create out of thin air if you're a bank. If you've got a banking license, you can create gold contracts, whether it's futures or forwards or whatever. The one thing you don't want to do is to take settlement. The swaps on COMEX have got themselves very, very short. And I'm sure that there are bullion banks in the same position in the London market as well, which of course is quite a bit larger. So it has been very much in their interest because they know what's going on. They've seen what's going on. They have been confused by it, but they now find that they are in a position of extreme danger with the physical stuff disappearing and the paper markets potentially losing control of the pricing. They want to close their positions down. And so consequently, they have moved very, very aggressively to do so. And if you look at the open interest on COMEX, it has virtually collapsed from something like 520,000 contracts down to, well, I think, last night we were looking at something like 430 odd thousand contracts, which taking it as an overbought, oversold indicator is very much an oversold indicator. So and the structure of the market has also changed against the swaps. The swaps basically have, it's mostly comprised of bullion bank trading desks. But the producers are not hedging. In the past, when you had the spike up at 1900 back in 2011, 2012, the producers were short of 200,000 contracts, over 200,000 contracts. And that, if you like, meant that the short position in the market makers was not nearly as great as it is today. So they were able to hit the market very hard, and they drove the price down from 1900 down to something like 1050 over a period of 3 years. The swaps cannot do that today because the position in the producers is that they are net short of less than 50,000 contracts. The rest of the short side in the COMEX market is being borne by the swaps. And if you look at what's been going on over the last 2 or 3 years with stands to delivery in the COMEX market, this is effectively taking physical liquidity out of the market. I mean, huge tonnages are being taken out. This year so far, since January the 1st, up to last week, roughly 253 tons of gold had been stood for delivery. And this is a non-delivery market. And compare that with the annual output of America. The annual output of the United States is around about 167,000 tons. That's the estimate for this year. Already this year, 253 tons has been stood for delivery on COMEX. That is the extent of the draining. Now, the situation for the establishment is getting worse, and they are becoming aware of this. And that is because of the massive level of savings in China. At a household savings rate of roughly 35% of GDP, that's the equivalent of $6 trillion at current exchange rates.
Imagine a world where gold, the age-old symbol of wealth and stability, is conjured up out of thin air by banks. This isn't a fantasy, it's the reality of paper gold. Banks with a special license can create gold contracts, like futures or forwards, without ever holding the actual metal. This financial magic trick has led to a dangerous game on COMEX, where swaps have become perilously short. The situation is equally tense in London, where bullion banks are in the same shaky boat. With physical gold supplies dwindling, these paper markets are on the brink of losing control over pricing. Desperate to avoid disaster, these banks are closing their positions at a breakneck pace. Just look at COMEX. Open interest has plummeted from 520,000 contracts to around 430,000. It's a clear sign of an oversold market. The market structure has shifted dramatically against the swaps, which are mostly run by bullion bank trading desks. Back in 2011 to 2012, producers were heavily short, but today's scenario is starkly different. Now, the swaps hold the lion's share of short positions, with producers net short by less than 50,000 contracts. This shift means that swaps bear most of the risk. And it's not just numbers on a screen. Over the past few years, massive amounts of physical gold have been drained from the market through deliveries on COMEX. This year alone, 253 tons of gold have been stood for delivery, far outstripping the US's annual output of 167 tons. This isn't just a market issue, it's a global economic concern. In China, household savings are a staggering 35% of GDP, amounting to about $6 trillion. The economic consequences of current interest rates are severe, and the Federal Reserve is feeling the heat. They're juggling the twin challenges of inflation and a slowing economy. Lowering interest rates might seem like a solution, but it's a double-edged sword. Jamie Dimon, a leading voice in American finance, warns of a grim economic outlook. Banks are tightening their lending, redirecting money from the private sector to short-term treasury bills to fund the government's deficit. This move only fuels inflation further. In this volatile landscape, understanding these dynamics is crucial. The reliance on paper gold has created a fragile market, ripe for disruption. Physical gold and silver, however, offer tangible assets that hold their value, even as fiat currencies fluctuate. As the world economy teeters on the edge, the strategic importance of precious metals becomes ever clearer. Nations like Russia and China are shifting towards gold-backed financial systems, recognizing gold's intrinsic value and stability. For investors, this means it's time to think smart and secure by holding physical gold and silver.
The economic consequences of the current level of interest rates are extremely serious, and the Fed will have an eye on this and be very concerned about it. So they've got this problem. How do they deal with it and inflation, the inflation problem at the same time? Now, I think that perhaps a consensus, with the US economy turning down, with inflation still continuing, et cetera, perhaps if they can sort of just muscle in a few cuts in interest rates, then consumers won't rush out and buy, sort of just put their money into goods and services and therefore drive up the prices quite so much. Perhaps a result of lower interest rates might end up taking a bit of inflationary pressure out of the steam out of the system. I can see them pushing that sort of argument, but it doesn't actually cut any ice. I mean, the person you want to listen to in America is Jamie Dimon. Dimon makes it quite clear that the outlook is very dangerous. He says he's pessimistic on the economy. And what this means is that the banks from the top downwards are restricting their lending. They cannot, in aggregate, cut their balance sheets. So what they're doing is they've diverted their lending from the private sector. And if you go around America and talk to small and medium-sized businesses and ask them about, the ability to borrow money from the banks, I mean, they will tell you in no uncertain terms, there ain't none. It's almost impossible. Instead, this money is being funneled into short-term T-bills, which has been basically funding the government's deficit. And the government's, you've had, there's a headline, a couple of months back, that the government debt increased by $1 trillion in 90 days. It's a pace that is accelerating. But the reason that it's happening is because all the liquidity in the economy is tending to go away from the private sector into funding government spending, which is non-productive and inflationary. So the inflation dragon is actually still being fueled. On top of that, with the foreigners not buying dollars and at the margin selling, as we've seen with the Chinese central bank, with the People's Bank of China, then that means that the borrowing along the yield curve is going to get increasingly difficult. And you're going to see interest rates, bond yields, far higher out along that yield curve.
Foreign investors are pulling back from the dollar, even selling at the margins, as seen with the People's Bank of China's actions. This retreat makes borrowing along the yield curve tougher, pushing bond yields higher. This scenario highlights the value of holding physical gold and silver as hedges against economic uncertainties. For our viewers, understanding these dynamics is crucial. The reliance on paper gold has created a fragile market prone to significant disruptions. In contrast, physical gold and silver offer tangible assets that retain value even as fiat currencies fluctuate. As the economic landscape becomes more unstable, the strategic importance of precious metals becomes clearer. Alasdair Macleod underscores a global strategic shift. Countries like Russia and China are increasingly moving towards gold-backed financial systems. This trend signifies a broader recognition of gold's intrinsic value and stability. For investors, this means positioning themselves to benefit from this shift by holding physical gold and silver. The ongoing depletion of physical gold reserves from Western markets to Eastern hands is a clear signal. The massive household savings in China and the strategic accumulation of gold by central banks indicate a long-term strategy focused on stability and wealth preservation. For individual investors, following this example can provide a hedge against economic instability and currency devaluation. For our American and allied viewers, it's vital to grasp the strategic moves of major global players like Russia and China. These nations are leveraging their gold reserves to bolster their financial systems, offering a hedge against the volatility of fiat currencies. By diversifying your investments into physical gold and silver, you can protect your wealth from economic instability. This strategy isn't just about preserving value. It's about ensuring long-term financial security in an increasingly uncertain world. Imagine a future where the dollar's dominance is waning and global powers are turning to gold for financial stability. This isn't a distant possibility, it's happening now. As foreign investors shy away from the dollar, borrowing costs rise, making the economic terrain even rockier. In this shifting landscape, physical gold and silver stand out as beacons of stability. Consider the moves by the People's Bank of China, which reflect a broader trend among investors, a pivot away from the dollar. This shift is pushing bond yields higher, making it harder to borrow along the yield curve. But in the midst of this, there's a silver, or rather, gold lining. Physical gold and silver offer a reliable hedge against these uncertainties, maintaining value where fiat currencies might falter. Alasdair Macleod highlights a significant strategic shift. Nations like Russia and China are gravitating towards gold-backed financial systems, recognizing gold's enduring value. For savvy investors, this is a call to action. By holding physical gold and silver, you can align with this global trend and secure your financial future. The depletion of physical gold reserves from Western markets to Eastern vaults is a loud and clear signal. China's enormous household savings and the strategic gold accumulation by central banks point to a calculated strategy for stability and wealth preservation. Individual investors can take a page from this playbook, using gold and silver to hedge against economic turbulence and currency devaluation. For those in the US and allied nations, it's crucial to understand these strategic moves by global powerhouses. Russia and China are not just stockpiling gold. They're using it to fortify their financial systems against the volatility of fiat currencies. By diversifying into physical gold and silver, you can protect your wealth from the economic instability that looms large. This strategy goes beyond mere value preservation. It's about ensuring long-term financial security in an unpredictable world. Stay informed, stay diversified, and safeguard your financial future with strategic investments in precious metals.